With the biggest buzzing business news of the day, this is Business at 9 on ET Now. I'm Vikram Oza. A very warm welcome to the show. In their latest update of the World Economic Outlook report, now the IMF, the International Monetary Fund, has increased India's growth forecast to 6.5% for FY25 as well as FY26. The growth estimates for the current fiscal, they've been upgraded by 40 basis points and have been brought up to 6.7%. This report highlights India's resilient domestic demand and as this major factor that would help economic growth. This is what is being cited by the International Monetary Fund. And at the same time, the financial agency has seen a soft landing amidst the declining inflation levels at the global level as well. So in that kind of scenario, let's get perspective. Garima Kapoor is Economist and Senior Vice President at Elara Capital, and she's joining us on the phone line. Garima, good to have you with us. How much strength do you actually see in domestic demand that supports the IMF's growth projection, even as we continue to tackle inflation in India?
Hi, Vikram. Thanks for having me over. I think IMF's up, the revision of forecast, I would say, were long due, especially after the second quarter print in India at 7.6%, as well as the 7.3% print of advanced estimates. So not completely surprised by these revisions. They should have happened earlier, but of course, IMF revises only twice a year, October and April. The second aspect with regards to demand, while demand has been softer in certain pockets, particularly in mass consumption, the discretionary segment, especially at the luxury or the upper end segment, has probably seen a very strong growth through the financial year. More than that, inflation as we speak has begun to moderate. So the latter part of the financial year, and probably more so for the next financial year, will actually see a gradual recovery at the bottom of the pyramid, which will also support the financial year FY25 growth. So I would completely say that not completely surprised by the upside or the upside revision that IMF has undertaken. But I would say that I would not be surprised if the actual numbers for financial year 24 end up eventually beating IMF's own forecast as well.
But Garima, how dependent are we on the moves that we see in commodity prices, especially when it comes to energy, especially when it comes to oil? How well we do as an economy is going to be dependent, but how much? This even as we try and ramp up our renewable capacities, how do you see that as a moving piece?
Vikram, thankfully, over the last couple of years, very good development has taken place in India's external sector, that it has developed a significant resilience for two major reasons. One, of course, is remittances into India is getting completely or relatively de-linked with oil price movements, because they're coming not just from significant Middle East sector, but also from relatively high-skilled pockets into Europe and other parts of the world, including US. And second, and more importantly, is that non-IT exports, basically led by the sprawling or the thriving GCC sector, are also giving us significant resilience despite volatile oil prices. More so, if you look at both demand and supply side of oil, it looks very clear that oil prices are likely to be very well behaved over the next financial year. One, of course, demand remains subdued, led by China, and supply is getting ramped up significantly, not just of that of oil, but also that of LNG. So I would say that the normal period where probably you do end up seeing a significant risk building up into the economy, over the last 2 years, these patterns are gradually shifting, even as India invests significantly into new energy landscape, and which will only continue to scale up in the coming decade. So I would say, notwithstanding where the oil prices are, even if they were to go at 85, 90 and stay there for a prolonged period of time, I think the resilience of the economy as well, especially in external sector, will help us maintain macroprudential and stability and probably continue to give some legroom for growth here on, despite if there is an expectation that is of oil price volatility and rise.
What about the kind of moves that the RBI is likely to make this year? They will need to pivot on interest rates and support growth. How soon do you think they will do it? And perhaps how soon do you think they need to do it to achieve the kind of projections that the IMF is making here?
Vikram, the answer to your question with regards to what RBI should do, I would like to split in two parts. One, of course, is that Fed has pivoted in its previous policy. You have Fed's policy this week, so you will probably look for greater cues of what Fed is saying. But the incoming data since the previous policy, Federal Reserve, has been relatively stronger. So the expectation expectation with regards to timing of the rate cut globally also probably is getting pushed ahead, especially in the US. Number two, in India's case, while inflation looks to be well manageable in FY25, my own estimates suggest 4.4 to 4.5% is likely to be a headline inflation from about 5.3, 5.4 current financial year. The problem is not with regards to the timing of the rate cut, but more so addressable issue seems to be the liquidity tightness. Now, with the surge in cash balances, the government side, with a relatively slowdown in spending over the last 1.5 months, the systemic liquidity in the banking system has been excessively tight. So I would say the first measure from RBI probably needs to come in through certain measures or steps undertaken to alleviate the liquidity tightness in the banking system, because that has the potential to stall growth or disrupt the growth momentum in the country. So I would believe the change in stance with regards to liquidity, as well as some measures to elevate the liquidity stress, are likely to precede that rate cut. But for entire financial year FY25, I am penciling in 75 basis point rate cut in India, starting somewhere around the second quarter of the next financial year.
Since you were talking about spending, Garima, what about capex? Will it have to continue to be led by the government? The private sector has a lot of catch up to do on that front. So very quickly, tell us how crucial that's going to be to raise India's growth momentum.
Vikram, while capex has been the key driver of the economy, let's not forget we've hit nearly an all-time high of gross fixed capital formation as a percent of GDP in the recent quarters. The sustainability of the growth of capex of close to 28-30% that we've seen on balance sheet of the government looks little difficult amid the fiscal consolidation path they need to meet, especially 4.5% by FY26. So, the rate of growth of capital formation and capex spending, especially by government on the budget, has to come down. My own expectations is somewhere about 19% for financial year 25, but the current data from the private sector remains patchy. So I think we still have some time, because next year at least government will be able to sustain growth of about 19% in capex. But post-elections, you should start to see some improvement in the sentiment of the private sector, because naturally there will be a significant number of announcements that would look for guidance both from post-election outcome and as well as the final budget that will be announced in the month of July this year.
That's right. We're going to have a vote and account on the 1st of February, and then, of course, we will get the final budget, but that is for the future. And we'll see exactly how close we come to this entire $5 trillion dream for the Indian economy, how quickly we can get there and become among the top 3 of the world's largest economies. Garima Kapoor, thanks very much for joining us on what the the International Monetary Fund is projecting by way of India's growth trajectory. Meanwhile,